Because if you go back to look at when yields started to spike, it was when the Treasury shocked the world. This is the same time that Fitch downgraded the U.S., the U.S. credit rating, but at the same time, the Treasury announced a massive increase in their financing for the second half of the year, which is something I've been harping on. They pushed it to 1.85 trillion of new issuance in 6 months. And realize, of course, that they're doing that at the same time that the Fed is shrinking its balance sheet. So it has the potential to be a true train wreck. So you could see interest rates continue to rise even as economic data softens.
All eyes are on this week's Jackson Hole Conference, an annual gathering of central bankers around the world. Jackson Hole has historically been market impactful, and investors are expecting this week to be no different. Of particular interest to market participants is what Fed Chair Jerome Powell might say during his speech on Friday. Here's a breakdown of what to expect according to the Financial Times. Since the Fed's meeting in July, two significant developments have occurred: a promising inflation report for July and a bigger than expected slowdown in U.S. hiring in the same month. Both suggest that the Fed could end its campaign of rate hikes at the current range of 5.25% to 5.5%. Still, another round of inflation and jobs data intervenes between the Jackson Hole Summit and the September Fed decision, so surprises on either may change the outlook even after Powell speaks. Now, another wild card is the Chinese economy, which posted a slowdown in growth, deflation in consumer prices, and a central bank that cut rates unexpectedly. Economists are wondering if weakness in Chinese data will be imported over to the West, but there's a slight problem. China has stopped reporting key data like youth unemployment. It's gotten so bad that U.S. National Security Advisor Jake Sullivan has called on China to be more transparent about the state of its economy, going as far as to say that these are not, in our view, responsible steps. You'll notice that I've used the Financial Times as my source of information, and that's because they've been one of my go-to news sources for finance and business reporting for the last 10 years. In my opinion, FT journalists are among the best in the industry, widely known for their breadth of coverage, objectivity, and thoroughness. Their award-winning team has 700 journalists around the world and more than 300,000 finance professionals using their data and insights. Now, you can get a 1-month trial for only $1 if you click on the link below, which will give you access to coverage of all asset classes in all markets around the world. U.S. Treasury yields have spiked to a 16-year high while the stock markets have continued to soften. So what exactly is going on? Where are the markets headed from here? The economy itself is putting in mixed signals, and we'll be discussing these signals and what's next in terms of growth with our next guest, David Hay, Co-CIO of Evergreen Gavekal, a diversified fund with over $4 billion in assets under management. David, welcome back. Pleasure to host you again for this episode of David Squared. Good to see you.
Thanks, David. It's always a pleasure to be here. You're looking very bright today, very bright and energetic.
Well, thank you very much. So are you. I enjoy your background, your very scenic background, and your Haymaker poster. Everyone should follow the Haymaker Substack, by the way. We'll put that link in the description down below. David, you've been calling for the bond yields to move, but you were right in calling for yields to go up a little bit more. And I think what has happened is that the markets are now predicting a soft landing. Is that something that you think is happening?
I don't think it's going to happen. I mean, it could be that we're in the soft landing phase right now, and that's transitional into a harder landing. I do realize the consensus believes that a recession is getting less likely by the day. I think one's getting more likely by the day. I'm not just always contrarian, but I think that there's just so much evidence that the economy is rolling over. And as I think talked about last time with David Rosenberg, we've already got a recession in profits, corporate profits. We've already got a recession in the industrial and transportation sector. We've already got a recession in government tax revenues. And we have a recession in gross domestic income. And I would argue gross domestic income is more important and more accurate than gross domestic product, GDP, which is the one that almost everybody's familiar with. So I apologize. We've got three of us on this interview today. I've got this pesky fly in the background. So, he probably was sent in.
The fly is my co-host, so I asked him to fill in for me when I don't have any questions. But bond yields, the Treasury yields, 10-year in particular, has shot up. It's now at the highest level in 16 years, highest level since 2007. Now, 2007 saw a similar pattern right before a recession. So people are wondering whether or not this is actually a precursor to a recession, or if the bond yields are signaling an economic recovery. Typically, when the long end of the curve, David, typically when that goes up, it could signal that an economic recovery is on the way. So it's a little bit confusing, especially when you consider that the S&P has been dropping for the last 2 weeks, while the yield on the 10-year has been rising.
Well, that can often happen is if you get interest rates moving quickly and the wrong direction, which is up. I mean, oftentimes stocks will go down. That's not terribly unusual. But I think you're raising a fair point, which is has the increase in yield we've seen since particularly this month, but mid-July, is that a function of economic activity coming in better than expected? Where some people are saying, forget soft landing, it's no landing, or it's a trampoline landing. So that could be the cause, not what I brought up when we talked with David Rosenberg, because as I think you know, one of my two uber fears for this year is that we've got this federal fiscal funding fiasco on our hands, the 4F. And frankly, I think that's what's really been behind this thing. Because if you go back to look at when yields started to spike, it was when the Treasury shocked the world. It's the same time that Fitch downgraded the U.S., the U.S. credit rating, but at the same time, the Treasury announced a massive increase in their financing for the second half of the year, which is something I've been harping on. They pushed it to 1.85 trillion of new issuance in 6 months. And realize, of course, that they're doing that at the same time that the Fed is shrinking its balance sheet. So it has the potential to be a true train wreck. So you could see interest rates continue to rise even as economic data softens. I think it's going to be a tug of war, and I think there's going to be some powerful bond market rallies along the way if there is all of a sudden a slew of weak data that comes out. But so far, I'd say you've got kind of the worst of both worlds for bonds, which is kind of resilient economic data combined with this massive onslaught of Treasury issuance.
So what you're seeing, actually, David, is if you take the 10-year minus the 2-year, the yield curve, that's been reinverting back to zero. Typically in the past, when it reinverts back to zero, we typically have seen a recession follow just shortly after. Is that a pattern that you've noticed?
Well, it's a very good point, and I think that needs to be understood that yield curves, when they're deeply inverted as they are now, that's a real warning sign, especially when it lasts for quite a while. I mean, basically, it's got 100% accuracy, and it's amazing how many people blow it off. And in fact, Francois Trahan had a great quote lately that inverted yield curves are easily dismissed, yet amazingly consistent. And it's true. It's just at 100% accuracy when it's this, been inverted for this length of time and to this degree. However, when you really get into trouble, which is kind of what you were touching on, is when the curve starts to uninvert. And what you can typically what happens is the Fed starts cutting frantically at the short end. So short rates go down a lot more than long rates, which also fall. But this time you haven't had that. You've had short rates, if anything, creep up a little bit, but the longer rates going up at a faster rate. So this will be what's known as a bear steepener. So a bearish bond market, but still a steepening yield curve, or at least in this case, a somewhat uninverting yield curve, which is quite unusual. But I think it speaks to what I've been harping on, which is the normal playbook. This is where I had a bit of a divergence with our esteemed host last time, our guest, is that you typically want to be extending duration, especially with treasuries, into a recession. I fear this time is different. We won't really know because I said earlier, you could blame this bond market rout recently on strong economic data, though there's a lot that's on the soft side, which we'll get to. But you could also say it's just because you've got this overwhelming amount of supply coming down the pike.
Could it be possible that the 10-year going up is a signal that the Fed funds rate may go up even more?
Yeah, absolutely. That's a possibility. That's probably the 2-year and the Fed funds rate tend to have a stronger relationship. But either way, I think that could be right. And I do think, we've got, Jackson Hole. I think that Powell's going to sound relatively hawkish. I don't think he's pleased with some of the economic data, though I would argue it's the lagging coincident data that's the most upsetting to the Fed, which wants to cool things down. And we know that the jobs market is very strong, but a factoid that just doesn't get the press that it deserves is that non-farm payrolls have been lowered. So everybody looks at the contemporaneous report, which is ridiculous because it's almost always wrong, particularly when you're in a transition phase in the economy. The non-farm payrolls have been revised for 6 months in a row. So for all year this year, they have been reduced. So that's telling you with those revisions, forget what I'm saying, just look at the data. That's telling you that the official jobs numbers have been off, which is quite common when you're at an inflection point from expansion to recession.
Well, okay, so people are just probably wondering then why is it not reflected yet in the official data?
Because of the lag factor. I mean, for example, if you look at part-time job creation versus full-time job creation, part-time jobs are increasing. It looks like more and more consumers are having to work at least 2 jobs. And that's been a pattern for several months. The other thing is that a lot of the job creation that is occurring within the official numbers is due to the birth-death model. So that assumes the number of business formations are occurring on kind of a normal trend line. And typically that's okay. I know we've talked about this before, but it's a really important point. But when the economy rolls over, and it's in the early stages of doing so, then the data's off because it's assuming you're getting business formations when you're actually getting business contractions. Perhaps you've seen that business failures are surging lately. So I think the birth-death model is thrown off. And it does that really at the end of every expansion. It throws knuckleballs at the forecasters.
People are also wondering whether or not there are bigger macro forces at play behind why the growth in the S&P has stalled over the last 2 weeks.
Well, I would argue you could make a very close correlation or linkage between the stock market correction and the bond market correction. So that could be one definite catalyst. And I sent you the chart, which I think is, certainly one of the most important for investors to be aware of right now, which is that the 30-year, arguably the 40-year, I don't even think it's very arguable, downtrend in interest rates has been decisively broken. Moreover, by spiking to 4.36% on the 10-year the last couple of days, though it's backed off slightly, we've broken that resistance level that was hit last fall. So the 10-year Treasury got up around this level about 430. We're now higher than that. Then it only touched that briefly, and it pretty quickly backed off, got down kind of 3.5 at the low, and that set a pretty good stage for a stock market rally. That was a fairly major easing on longer-term Treasury rates. So I think there's a very tight connection. I also think that stocks just got too high, too expensive. I think I might have sent you my July 28th newsletter where I actually went out on a really shaky limb and said that I felt the QQQ was ripe for profit taking and for more aggressive people to even buy puts on it. And it has suffered. I mean, Tesla in that period of time is down about 25%, even after bouncing a little bit lately. But pretty much, all the Magnificent Seven, from mid-July, their peak in mid-July, they're down about 10%. So that's, it's kind of telling we got very crowded, very, very crowded. And valuations were, really punchy.
You sent me a few charts before the interview, and it's interesting how people may interpret some of these charts, and I'll explain these charts and I'll show them. People may interpret these as positive economic news and perhaps a signal for more strength in the economy. One of them is a return in the money velocity, rather. The money velocity here is defined as a nominal GDP divided by the money supply. Now, it's collapsed pretty much during the pandemic, but it's been rebounding very aggressively over the last year. Why is this happening, first of all, and what is this signal?
Well, I'm really glad you brought that up because I only sent you that one chart, which is actually kind of contrary to me. And I like to challenge my beliefs and show data that's runs against what I think is happening. But this one does show money velocity increasing. And I guess that is logical. So the thing about money velocity is that it is a derived variable. It's a dependent variable. And if you have GDP increasing at the time the money supply is falling, which is what we've had lately, then by definition, velocity is rising. So in that purely technical form, it is improving. Now, on the other hand, and this is where you get into lies, damn lies, and statistics, Lacey Hunt, who's a genius, has another way of looking at it. He looks at ODL, other deposit liabilities. He thinks that's a better and more timely measurement of money supply, and his velocity is falling, which to me makes more sense. I mean, I realize the chart that I sent you indicates, which maybe what's going to be the reconciling factor is that we see a sharp drop off in GDP. Obviously that would be consistent with a recession. It would be consistent with the other 4 items that I mentioned earlier already being in recession. But just statistically, that chart that I sent you makes some sense. I think there's a high degree of uncertainty is if that continues. I obviously don't think it will. So what I'm saying is I think that GDP is going to catch down to Lacey Hunt's velocity chart, which shows it continue to fall.
So just to clarify for our viewers here, the higher money velocity does not necessarily indicate that people are spending more money or that they have a higher propensity to spend?
I think that the latter, it would indicate that, I mean, if the amount of money is contracting and yet economic activity is strong, that means that kind of the money multiplier must be accelerating, which to me doesn't make sense. And that's where I question the validity of this chart, other than perhaps on a short-term basis. And the reason I say that is that, and this has been a theme of mine for 6 months or so at the banking crisis, is that we've got this mass exodus of money out of the banking system. Even if it doesn't leave a bank, it goes from the bank deposit into a, say, government money market fund at that bank, convenience sake. But that's going from high octane money to low octane money. And this is happening, on I don't think there's any probably about it. It's happening on an unprecedented scale. So that's got to hit, because, that money, when it's in a bank deposit, could be multiplied by a factor of 10. When it goes into a government security, it's basically got no multiplier to it. So that doesn't make sense to me that the money velocity would be accelerating right now. But like I said, I like to challenge what I say and show kind of conflicting evidence.
I don't think the data here is incorrect. That the St. Louis Fed has a similar chart, except they use the M2 money stock and GDP over M2. Here, I think it's using a different money stock data series. But yeah, it's the same pattern. The Fed's numbers are going up as well. So yeah, it is interesting. Another chart that may signal bullishness.
But David, just to be clear, but what could really be the difference, and this happens so frequently at the beginning of a recession, is those GDP numbers get revised down. Just like we're talking about the non-farm payrolls. So, I mean, for example, in December of 2007, it looked like the economy was expanding at a healthy clip. The S&P had made a new all-time high in October. And yet, within a few, 6 months, 8 months, we were in the worst recession since the Great Depression. And actually, the NBER, which is the official arbiter of recessions, went back and said, oh, the recession started in December. And everybody thought things were fine, other than housing at that point. And actually, this economy, and you may not know this, but you're on top of things you probably do, that actually the growth rate of this expansion has been the weakest in any Fed tightening cycle. So despite this, recent flurry of stronger data, the overall growth rate of, real GDP has been quite a bit lower than average in a tightening cycle. Usually, the Fed tightens and tightens and tightens, the economy continues to do really well, and people say, there's no recession coming. Then all of a sudden you have the Wile E. Coyote moment for the economy. So this is not, on a historical basis, this is a subpar expansion.
Yeah, the GDP Now model estimates for real GDP growth is 5.8% in the third quarter of 2023 as of August 16th. So their last readings, the last estimate. The strength is based on this morning's housing starts report from the U.S. Census Bureau and industrial production report from the Federal Reserve Board of Governors. So yeah, this is a very interesting development. The government, well, the Atlanta Fed in particular, is expecting GDP to accelerate in terms of growth. What do you make of this?
Well, do you have the St. Louis Fed?
I don't have it in front of me, but we can pull
it. They're much lower. Maybe they revised it up here recently too, but the last I saw, they were barely over 1. So there is some divergence there. But there has been a bounce in some of the data, though I would argue with housing. Yeah, housing did. It had looked terrible at the beginning of the year. Then it had a pretty good rebound, and the home builders have gone nuts. They basically touched an all-time high, but housing is down again. The builder sentiment was reported very weak here recently, and of course, volumes are way down, and the existing home market is basically frozen. And what you're seeing, the activity you're seeing, is with new homes, and because of significant builder price cuts. But as you know, as well as anybody, affordability is terrible. And this latest spike in interest rates is not good news for housing affordability.
That's right. But it's ironically good for the home building industry.
Well, they're dealing with it by cutting prices, or even, offering cut rate financing, buying the mortgage down to 5% for their buyers. So yes, they're adapting. You got to give them kudos. Their balance sheets are much stronger than they used to be, but I think it's nuts to have them priced where they are. The stock prices, I think, are too high given the fundamentals. And I'm personally short. I know Buffett is buying some, so I'm going contrary to Warren Buffett, which is never a great thing. But to me, it looks like a classic double top in the XHB, which is the home builder ETF.
Yeah, we do have this chart. So yeah, that was my next question: whether or not you'd be buying more on this on current levels. But I guess you're not seeing more growth ahead. Okay, is that purely based on a technical basis because you think it's reached a level that needs to see some sort of correction, or are you just betting on home builders' steam slowing down into the next quarter?
No, I think this is a pattern that we saw back in 06, 07, where there was a substantial weakening of volume sales and prices were sticky because people were kind of in denial for a while. But then once people start to have to sell, then they have to mark to market. And that's when you get the second down leg and people really wake up to the fact that it is not a healthy housing market. I just don't see how you can have affordability as poor as it is right now and have the market function. And again, builders, they can kind of play the game of, well, we'll take the margin hit, which they are. I mean, that's another reason why I'd say it's not that great if you're in that business. I mean, they're making money, which is a lot better than they did in 07, 08, 09, but they're having to take price concessions and eat the margin hit.
Right. You've talked about bubbles, economic bubbles a lot in Bubble 3.0 and also Bubble 2.0, two books I recommend people check out. But would you characterize the residential real estate market right now as being in a bubble, according to your own definition?
Well, I think it was, and I think the bubble is kind of slowly leaking. I thought it would be more explosive. It has been more explosive. The unwind of that in certain countries like Sweden, which frankly, the U.S. compared to countries like Sweden, like New Zealand, like Australia, like Canada, our bubble was much less, but it was still, I mean, even adjusted for inflation, prices got higher this go around than they did in 2007, which is pretty remarkable when we consider that was, going to be like the bubble to end all bubbles, at least when it came to real estate. So I think this is a less explosive implosion of the bubble than what we had back in 2007, 8. But I still think that it's the trend in housing prices is down. And I think that there's been the normal lag with the existing homes for the reasons we talked about. I mean, if you're an existing homeowner, you don't want to sell, right? I mean, if you've got a mortgage of 2.5%, unless you get a great price. And so I think that some of the people that are on the market right now they're trying to get 2021, early 2022 prices. If they get those prices, then they can afford to pay a higher interest rate on a mortgage, but they can't get those prices. So that's why you're seeing volumes, so low. It's not a great time to be a real estate broker. I'll tell you that.
David, this is an issue I've been wondering myself. Suppose the mortgage rate comes down at some point, maybe after the Fed pivots. Would you, first, a two-part question, I'll ask the first part first. Would you then see a flurry of selling activity once people realize that they could probably buy another home for cheaper?
Well, for cheaper. I mean, I think that's got to be the main variables. I think that because it's unlikely the Fed's going to be cutting interest rates anytime soon. If anything, they're probably going to hike at least one more time, given the current set of data. I mean, imagine cutting when you've got the Atlanta Fed telling you the economy is growing 5.8, even though I think that's an inaccurate figure, but let's just say that's the official one. They're not going to cut. If anything, they're going to hike. And the odds are rising. If you look at the futures market, the odds are hiking of another Fed increase. So, I mean, it's pretty amazing when you think about where people thought the Fed funds rate was going to top out, say, a year ago, how much further we've gone beyond that, and yet how well stocks and home prices have done. So I just don't think prices have adjusted to the interest rate reality yet.
Suppose the investors who have bought second or third homes decide to sell at some point. Now, this is a lot of money that they're just leaving on the sidelines. Would it be actually better for other capital markets or asset classes if we see a flurry of selling activity in residential real estate? Because that money has to go somewhere. I'm assuming it's not the savings accounts of people.
Well, first of all, I think it'd be great for first-time buyers. And I think where I thought you were going, you kind of did a little bit, but where I think you could see a lot of supply is from some of these, non-user buyers. And they're non-occupied homes where they're investments or Airbnb. What I keep hearing is we're going to see a slew of supply coming from people that bought homes, put into Airbnb. They're not getting the rentals that they thought they were going to get. Now they've got higher property taxes. They've got higher insurance. Insurance rates are going nuts in a lot of places. And of course, their opportunity costs. If you sell that house, which is, let's say, dead money, and you put that into a treasury yielding 5.5, that's a pretty nice pickup. So that's where I think you're going to see the supply come from. Not so much from the occupied properties as the unoccupied properties.
One more indicator I want to point out to you is retail sales. Advanced retail sales in the U.S. They were the last reading in June. The prior month in June, it grew at 0.5% on a year-over-year basis. In July, the latest month, it spiked up to 1.98%. So advanced retail sales is improving somehow. A year ago, we may have attributed this to inflation, but inflation has been coming down, at least on paper. So I don't know how much of this we can attribute to the inflationary base effect. It seems to me like people are spending more money, and it's a weird contrast to the PMI numbers falling. Can you make sense of this?
Well, not really. I mean, it is very confusing. I think it's, in fact, I heard Seth Klarman or read that he said this is one of the most confusing times in his career. For your listeners who don't know who he is, he's absolutely legendary in our business. I mean, really a little bit younger Warren Buffett. And it reminds me of the old Edward R. Murrow quote that anybody who isn't confused doesn't really understand the situation. And I think you can just look at all these indicators and charts and you go, well, I don't know. That's just, you can take whatever interpretation you want, which again, I think that's typical at this stage of transitioning from expansion to contraction. This is not unusual. It's like the changing of the tide in the ocean, when it's, there's kind of that slack tide moment where we're going from, rising tide to ebb tide. And so we're kind of in that phase right now. But I think it's also important to look at, the government statistics are, especially the ones that are released contemporaneously, are just notoriously inaccurate. And again, particularly when things are shifting. But you listen to the Walmart. Walmart, was viewed as having this great quarter, but you listen to what the CEO said, and he said that consumers are buying more necessities and focusing on lower priced items and brands, a good indication of how the consumer is being pressured right now. And Walgreens CEO said basically the same, more cautious and value driven. Then you have Dick's today, which the stock's down 25%, sporting's good. And so you have the government statistics, which everybody seems to hang their hat on. Then you've got the real world stuff where it really isn't as good. And even Home Depot, Home Depot is 3 quarters a row now of lower sales. And a lot of the increase on the top line that you're seeing is because of price increases. I mean, PepsiCo, David, increased prices by 15% in June, just this past June. I mean, that's the kind of stuff we were seeing back in 2021. Look at these wage packages that you're seeing from the American Airlines pilots and the UPS people, the UPS drivers, and now we got the UAW. So we've got the situation where in certain areas, you're getting really big pay increases. You're getting really big, price hikes. I mentioned insurance. Insurance rates are just going nuts. So it's a very bizarre situation where you've got certain areas where there is some disinflation, if not deflation, and yet other areas where inflation is still running really hot.
Lastly, do you think inflation is going to come? You mentioned inflation is going to stay sticky, but is it going to rise from current levels? Do you think there may be some forces, maybe from energy or supply chain bottleneck disruptions that may push inflation up more from current levels?
Yeah, I think we could see a second wave of inflation in the second half. I suspect it will be, in this case, truly transitory, because I do think that as the recessionary forces build, that will tend to lower prices, cool prices off. But I do think that a big part of why inflation came down so much over the last year is because of energy prices. There was a significant energy price decline, and there was a significant commodity price decline overall. And those are shifting, particularly with energy. Major rally in the price of oil. And last time I was on, that was an area that I was pretty optimistic about. I thought oil was too cheap, and I thought the energy stocks were going to rally. Unfortunately, they have. But I think I still believe oil is going to triple digits in the not too distant future. And so that just percolates through the economy in so many ways. I also think natural gas prices could have a significant increase, but it's really surprising to me that at this stage, when you've had a lot of input prices cool off, that these consumer facing companies, it's not just Pepsi, it's Coke, it's J&J, it's Procter & Gamble, it's most of the food products companies are still pushing through price increases, 8 to 12%.
Wait, just real quick before we close off, triple digit oil price in the not so distant future. Can you explain your thesis here?
Sure. It's really SPR releases are over. I mean, that's what was the number one source of supply over the last year, was the SPR being drawn down to alarmingly levels, dangerously low levels. And that stopped. In fact, it has to stop by mandate. Cannot go lower than it is currently. And the Biden administration I think they missed the market. They had a chance to replenish at low prices. And so far, I don't think they bought a single barrel. Maybe they bought a small amount. I can't say that for sure, but whatever they bought back has been negligible. And so that stopped. And you've got a inventory levels adjusted for the SPR releases. So if you take those away and you look at the inventories, so kind of adding back the SPR to where it used to be, inventory levels are the lowest in 30 years. So it's and obviously the demand for oil is much greater than it was before. And that's the other thing is demand has been consistently underestimated, and it looks like it's running at about 103 million barrels per day. I think next year we could be easily 104, 105 million barrels per day, and yet supply is actually starting to really have a hard time sustaining itself. And the Permian Basin in the U.S., as I think is huge in that regard. And U.S. shales, which in the Permian is the biggest of all the U.S. shales, have been responsible for 90% of the production growth over the last 15 years. And even the Permian, which is the best producing oil basin in the country, maybe the world, is now showing signs of fatigue. Productivity is dropping pretty significantly on a per foot, lateral foot of well development. Because as you know, with fracking, what they do is they go horizontally. And because it's getting harder and harder to produce oil, they have to go further and further horizontally to get the same amount of oil. And shale depletes or has a decline rate of about 40% a year in the first 2 years of a new well's life. So the decline rate on these wells is pretty shocking. And yet, the drilling activity is down substantially. The drilled but uncompleted wells are way down. I think we're just going to have a supply crunch at the same time that demand is increasing. So that's why I think 100 plus is entirely reasonable. Don't ask me when, but I think sooner than most people believe.
Okay, but you don't think that a recession would kill demand?
A little bit, but probably 1 million and 1.5 million barrels is what you would lose from a recession. And that's just the deficit's going to be more like 3 to 4 million next year. So it will make it less of a problem. And, there will be times oil prices are very volatile. There's way more trading, something like 30 times as much trading of paper oil than there is of real oil. So you can get some sharp declines for sure. And I'd be a little leery chasing oil after the run it's had. But I think the trend for the next 6 to 12 months is decidedly up, even with the recession. Remember my two really renegade calls: higher oil prices in a recession and higher interest rates in a recession, at least on the long end.
Yeah, well, the higher interest, actually both have been playing out pretty consistently according to your calls. We haven't officially had a recession yet as designated by NBR or other agencies. But yeah, both of your calls have been correct so far. Now, David, I wonder how you're allocated. Let's close off an allocation. Given your thesis, which sectors or assets do you like the most right now?
I still like commodities. Ironically, one of my favorite areas is actually a green energy play, because people kind of put me in only the fossil fuel camp. But a number of these renewable, almost MLP types of securities, they're called GenCos. They've been crushed, including the premier company in that area. It's down almost 50%. It's yielding 7%. It's grown its dividend at about a 10% compound rate, predicted to continue to do that. And they're connected to the best renewable utility in the country that's also one of the fastest growing states. So that's, I think, an area of opportunity. That's an area we've done a lot of profit taking in the past when it's run up, and we bought on weakness. This one has been, we were a little early in rebuying into this one because it's gone from 84 to 47 over the last year plus. So that's an area. I think the XLI, which is the industrial ETF, it's had a very impressive multi-year breakout. That's something we look for, David. As I think we look, where's the trading range that's lasted for at least 3 years, and when it gets violated or penetrated on the upside, they continue to run usually. And I think that plays into the reindustrialization of America approach. But it's probably a little bit extended. I think most things right now I would nibble on. We put out a table pounding buy on energy around the 20th of June when energy was really cheap, but it's not so cheap anymore. So there are pockets of value, is the way I would say it. I think uranium continues to look very attractive. There's a huge nuclear renaissance going on around the world I don't think most people are aware of. So those are a few areas that I think look pretty interesting.
Okay. We haven't talked about China much. We can save that for another conversation in more depth. But I'm wondering why your bullish outlook on commodities hasn't changed despite the negative press coming out of Chinese economic growth. Their consumer sector saw deflation. Evergrande just collapsed. Youth unemployment is so bad they stopped publishing those numbers.
You're right.
It's not looking great for the world's second largest economy, which also happens to be the largest consumer of raw commodities. So what's going on there?
And I think you want to be selective. For example, copper. And China obviously uses a lot of copper, but this great green energy transition we've talked about is going to consume enormous amounts of copper. And I think the reason copper is down is because of fears of economic weakness in China. And actually, copper inventories, despite that, are very low. So it's kind of like the oil story. So I think that there are certain commodities that will do well even in a recession. I mean, you just think about how much copper is going to be consumed in the reindustrialization of America. So I think you got to be choosy, but that would be another one. The largest copper producer in America is, down fairly substantially from its high, about 30%, and looks really attractive on a long-term basis. That's another one I'd put in the light column.
Okay. Final question for you, David. In light of everything we've talked about today, what would change your mind about economic growth? In other words, what data or series of data would you need to see that would definitively prove to you that, all right, we are actually on track for a soft landing or perhaps no landing at all, and it's time to shift to a more, I guess, aggressive cyclical stance?
Excellent question. Very fair one. I think to see a shift in the trend of the leading economic indicators, and that would literally be the LEIs, which just came out down for 16 straight months. And the yield curve is another very strong leading economic indicator. And that's the problem is that if you, in the PMI, by the way, too, the GDI that we talked about earlier, the gross domestic income versus product, that's had a more accurate track record. And every time it's been down while GDP is up, GDP then went down to match GDI. So many of these things that only happen on the verge of a recession are happening and continue to happen. So if those started to shift, then I would say instead of, kind of me poo-pooing these lagging indicators or coincidental ones that get revised so drastically, and when it's turning down, they get revised southerly. So because that's the real problem, and this is, I think, where the Fed gets into a dilemma time and time again, is they tend to be very focused on the coincident and lagging economic data. They're aware of the leading, but for whatever reason, because they've never forecast one recession. Earlier this year, some Fed people were saying there's going to be a recession. They backed off that, what they do is then they tighten and tighten and tighten because they don't see the contemporaneous data weakening, and then all of a sudden it goes boom. This stuff is a lot interrelated and interconnected. So when things start going wrong, they tend to go wrong kind of in a chain reaction. And then the Fed goes, oh my God, our rates are way too high. We have to start cutting like crazy. But I think that's not going to happen for a while, frankly. That's what the market wants to have happen. The market wants both, right? They want the Fed to be cutting like crazy and the economy to avoid recession. I mean, are those two going to happen? I don't think so.
Fair enough. All right. Well, that was a very thorough overview of the bond markets and the interesting direction of the yield. So thank you very much for that. Where can we learn more from your work? Well, tell us about the Haymaker Substack and some of the themes you're exploring and working on right now.
Well, pretty much what we've talked about. What we try to do in our Friday Haymaker is to give fairly specific investment guidance, which is kind of different than what most of our peers do. We spend a lot of time on income ideas, which frankly I think get short shrift within even the money management community, but also within the newsletter writing world. I mean, most people that have money are older and they want cash flow. And yet there's so little guidance on that, frankly, out there. And that's really our strong suit. That's where we've had the best performance, relatively speaking, over the years by far. I mean, frankly, we've crushed our comparative indexes. So there's a fair amount of guidance there in our Haymaker on Fridays, but we also will mention individual securities somewhat cryptically because you know how it is in our business. The SEC breathes down our neck. It does amaze me that some of my competitors get on CNBC and they're just boldly talking about what they're buying and own. But our compliance people are very conservative. But still, there's enough to go on in those. Our Monday, Making Hay Monday, is more of a macro piece where we go into a little bit more philosophical or big picture types of themes. And that one, we still provide about half of it for free. We do a couple of charts of the week. Since the last time you and I talked, we've gone behind the paywall. for most of our content, but there's still quite a bit of free content. So I'd suggest go there for your people that haven't already. Try it out, see what you think. And then we've actually got our, just kind of our regular tier and then a founding members tier, where my goal is to really spoil those people with all kinds of special data. And we're going to do regular, events like this where they get to ask questions. And so it's a pretty scary and exciting time for us in Haymaker land right now.
All right. Yeah, check out David's writings at the Haymaker Substack. We'll put the link down in the description below. And also to his books. We'll put a link in the description where we can learn more about bubbles. So that's an interesting topic. Thank you very much. We'll speak again soon.
Thank you, David. I appreciate it so much.
Yeah, appreciate it as well. And appreciate you tuning in to this episode of David Squared. We'll have more for you. Stay tuned and don't forget to subscribe.